What's good, YouTube? Welcome back to another episode of Bird's Eye View. I hope everybody enjoyed their weekend and their Easter Sunday. Hope everybody ate some good food, and I hope y'all went to church and got the word. I'm a little behind on this video because last week was just crazy with work. I thought I would have time to record and edit on Easter Sunday, but that obviously didn't happen. But anyways, here we are. I'm gonna keep that intro short on this one because I got a lot of good information for y'all and some good tips. So let's just get straight into the disclaimer. This content is intended to be used for informational and educational purposes only. These are not formal investment recommendations. These are just my opinions on what I see in the market and what I'm doing with my own money. Please do your own research and only make investment decisions based on your own personal circumstances. So with that being said, let's jump into it. As I said in my last video, it's best to start with a wide view so you can start seeing how all the pieces fit together, and then you can start narrowing your focus to see how to make decisions based on the information that you have. Now, I want to talk about something that's extremely important that I feel like not enough people are talking about, and it'll really shed some light into why Trump is going on this tariff rant in the first place, but also shed some light on the consequences that America could face if it's not viewed in the best light. So since 1944, the US dollar has been a reserve currency of the world, which basically means that it's been the most trusted currency and it sets the value of all other currencies around the world. That's why traveling to countries like Japan, Mexico, and other areas of Latin America is significantly cheaper because the dollar is valued much higher than their currency. This essentially gives the US control of the entire global financial system, which is why the US has been big dog for the past 80 years. Now, this gives the US benefits that other countries may not have, like borrowing money at much lower rates, and also makes our capital markets like our stock market and our bond market so strong. Now, just to give you some context on how strong our capital markets are compared to the rest of the world, I want you to understand a concept called GDP. GDP is an acronym that stands for Gross Domestic Product, which is the total of all products and services sold in a given country or a given region. Now, the global GDP, the total of all products and services sold around the world, adds up to about $90 trillion. The US Treasury market, where bonds are sold, adds up to about $28 trillion. So you got about a third of the total value of the world sitting in the US Treasury market at any given time, which is huge. Like, that is why the US is such a big player in the global economy. That's why the US has been a bully for so many years, because can't nobody do nothing about it. No other currency has been as strong as the US dollar for the past 80 years. Now, the reason for that is because bonds have typically been the safest investment that you can make, even in times of turmoil. A bond is basically debt that the US owes to somebody else. And everybody invests in bonds, from retirement accounts, pension funds, foreign governments, sovereign wealth funds, everybody. Like I said, it's about a third of the total value of all products and services sold in the world. And when the US sells a bond, it's basically the US saying, give me your money now and I'll pay you back in 2 years, 10 years, or 30 years, depending on what type of bond you purchase. But until I pay you back, I'm going to pay you interest every year on the value that you paid for your bond. And then at the end of that term, I'll give you your money back. So US bonds have typically been the safest investment that you can make no matter where the world is at any given time. However, for the first time since World War II, that status is in question. Now, remember I said the US Treasury market accounts for about a third of the world's GDP. And because it's so large, the bond market tells you a lot about how confident other countries are in the US economy. And you can tell that based on how interest rates of bonds move, because the price of bonds and interest rates of bonds have an inverse relationship, which means that as prices go up, the interest rates of those bonds goes down, and vice versa. When prices come down, the interest rates of those bonds go up. So when you see a big jump in the interest rates of bonds, that means that other countries or a large institution is selling off a large portion of bonds. Now, typically that wouldn't normally be a problem, because a lot of times people will sell bonds and put that money back into the US stock market when stocks start recovering and doing well again, or they put that money into the value of the US dollar itself. And recently we haven't seen either one of those things happening. So what does that mean? If the money is not going into our stock market and it's not going into the US dollar, that means these foreign countries are taking their money out of the US and putting it into other places, like their own economies, or like other foreign countries like Japan, like Germany, like China. So right now we're at a crossroads where these other countries are trying to decide, do we want to stay on the team with the US like we have been for the last 80 years? Or are we not rocking with the US and we want to go test the waters with somebody else like China? So countries are trying to decide whose team they want to be on. And the U.S. is not doing a good job of making them sound confident because Trump is going on this rampage right now where he's trying to bully all these other countries and flex the U.S.'s muscles, even though we're in a weak position right now, while also creating turmoil within the country. So we going to war over here with all these other countries, but then we got beef in house. Like you can't have two things at once. You're spreading yourself too thin. You can't fight with everybody else and fight amongst yourself. The Bible has a phrase that says, "A house divided shall not prosper," and that's kind of what's going on with America right now. So we at a point where we're closer to the outcome of the U.S. dollar no longer being the reserve currency than we have been in the past 80 years. Now, it would take years for that to happen. We're not close to that yet. But as I said, we've never been this close to that even being a possibility. But right now it is because other countries are spooked. And even if we do, get back in the good graces of those countries, there's no guarantee that the relationship will still be the same. I'm not telling you this to scare you. I'm telling you this to stay informed because there may come a point where living in the US is no longer viable. Like it won't become a third world country, but will no longer be the world economic power. And that's bad for the US because we've been a bully for the past 80 years. We've been walking around talking our shit and telling everybody else how to move. So what's going to happen when it comes to a point where we no longer have that power? Just something to think about, but this is something that we have to stay informed about. And I want you to be aware of what is happening in the big picture that affects you personally and your wallet. Last week, I gave some companies on my watch list that were reporting earnings last week. So I wanted to do a follow up and give you all some of those metrics that I saw in those earnings reports. And the first one up is Taiwan Semiconductor, which is one of my favorites. They had a great quarter. They reported revenue of $25.5 billion versus $18 billion last year. That's a growth of 41.6%. They reported net profit margin of 43% versus net profit margin of 38%. Remember, net profit margin is for every dollar that you make, this is how much you get to keep. And anything over 20% is good. TSM is at 43%. They beat analysts' expectations. However, their stock did have a pullback last week. I said that Trump announced an exemption of semiconductors from tariffs on other countries. And even though those are persisting, Trump said, even though those are exempted from the country's tariffs, we got a separate tariff coming just on semiconductors. So a lot of semiconductor stocks went down last week. However, a lot of analysts still have TSM as a strong buy because it's so essential to the global economy and the AI revolution. So TSM is still a buy in my book and still a company that you should be interested in. Then another one that I pointed out was Netflix. Netflix's stock actually did do well. Netflix's stock jumped about 5% after they announced earnings, which is really good in a single day. They announced revenue of $10.5 billion last quarter versus $9.4 billion last year. That's a growth of about 12%. They reported net profit margin of 27% versus net profit margin of 25% last year. They kept their guidance the same, meaning they still see revenue and earnings growth this year. So they probably won't be hit as hard by tariffs as some of these other companies. And the reason being is because even if spending slows down and people stop traveling and stop eating out and things like that, the last thing people stop spending on is entertainment. When you're in the house for longer, you're watching TV more and you're consuming more. So Netflix will still do well. And the other one was American Express. American Express also beat their earnings estimates. They reported revenue of $17 billion this past quarter compared to $15.8 billion last year. They reported net profit margin of 15%, which was consistent with last year where it was also 15%. But one thing that I thought was particularly interesting in American Express was the net write-off rate. The net write-off rate is basically money and credit card balances that these companies don't expect to get back, so they keep reserves on the side to account for these losses. American Express's net write-off rate is 2.1%, which is much lower than other banks like JP Morgan and Wells Fargo. Their average net write-off rate is 4.3%. And the reason for that is because American Express's users are typically more affluent, more high net worth individuals, and also corporate accounts. So they won't be hit as hard by tariffs as some of these other companies because their users are more financially well off. American Express probably won't be hit as hard as some of these other companies as tariffs get announced. So that's still a company that I like a lot. And coming up this week, Big earnings we have coming up are on Tuesday. We have Tesla and Capital One. Tesla, I'm particularly interested in because they have not been doing well recently. Their sales have been dropping all around the world. There have been a lot of protests against Teslas for Elon Musk actions, and also they had a big recall of the Cybertruck, which was supposed to be their biggest stock bump of the year. So if they disappoint in this earnings, their stock could take a real dump. Capital One is another one I like on Tuesday. They just announced an acquisition of Discover, making them the largest holder of credit cards among all banks. That's huge. So I'll be interested to see how that affects their guidance going forward. Wednesday, we have Boeing, the airplane manufacturer. We also have Vertiv Holdings. I've been following Vertiv Holdings for a while. They are a data center cooling company, which is very important. The biggest drawback of these powerful AI chips is that they create an extreme amount of heat. I read an article that said that people were using ChatGPT so much that the chips inside the data center started melting. So Vertiv Holdings is very important. They have a partnership with NVIDIA to cool their most powerful chips. However, their stock was hit because they get a lot of their parts from overseas, so people got scared because of tariffs. I want to hear how they're going to be navigating this landscape. And then you have Google, the second contributor from the Mag 7 that will be reporting earnings this week. And then you have Intel, which is another chip company. However, Intel hasn't done very well because they've been lagging behind companies like NVIDIA and TSM. But they recently announced a new CEO. So I'll be interested to hear what his strategy is on how he's going to catch up to the competition. So these are the earnings that you should be looking out for this week. Last week, I said I would go into more detail about brokerages that I thought would be suitable for new investors. And as promised, I've created a list of 5 brokerages that I think would be great for new investors and experienced investors alike. So starting off, I have Fidelity. Fidelity is, I would say, the number one all-around broker because it kind of gives you the best of everything. Fidelity is a full-service broker, which means that they have a number that you can get in touch with customer service, which is great. They have no account minimum, and they charge no fees for stocks and ETFs. They have a great educational content library. So if you're looking to learn more about investing and get more familiar with things, Fidelity has, great educational content for free. The thing that sets Fidelity apart is their passive income on uninvested cash. When you push your money in a brokerage account, it's not automatically invested. It kind of just sits there like it would with a bank account. But Fidelity offers you 4% interest on any cash you have just sitting there, which is comparable to a high yield savings account and much better than a traditional savings account that pays 0.01%. Fidelity kind of gives you the best of both worlds and is my top brokerage pick for new investors, especially. Number 2 is Charles Schwab. Charles Schwab is also a full-service broker that has great customer service. They also have no account minimum and charge no fees for investing in stocks and ETFs. But what sets Charles Schwab apart is they probably have the best educational content out there. Back in 2020, they acquired TD Ameritrade, which was a great financial education platform. Paired with Charles Schwab's own educational platform, their content is best in class and it's free. So if you're looking to learn more and get more familiar with investing, Charles Schwab is a great pick. It's my number 2 pick. Number 3 is E-Trade. E-Trade also has a good educational content library. I'm personally looking to upgrade to E-Trade myself because it's a little better than the platform that I use now. They also have no account minimum, and they have a very simple mobile interface, especially for options trading for my traders out there. The only downside to E-Trade is E-Trade does not allow purchase of fractional shares of stocks, only ETFs. So if a stock is about $200 per share, you can't put $50 in here and then maybe $20 here. You have to purchase the entire share of the stock. But ETFs, you can purchase fractional shares, so you can put $20, $50 in here and there. That's the one downside to E-Trade. However, it's still very good and easy to get acclimated with and get familiar with. So that's my number 3 pick. Number 4 is Webull. I personally use Webull. I've been using Webull for about 2 years now. Webull is great for new investors, and it's a very simple mobile interface and desktop interface, so it's easy to get used to. Webull has no account minimum. They charge no fees for stocks and ETFs, and they also have very low fees for options, which makes it attractive for newer options traders. Webull is very beginner friendly, so you can't go wrong with that either. And then 5 is Robinhood. I'm not too keen on Robinhood for a couple of reasons, but it's not terrible. I just think there are some better options out there. Robinhood is not bad for beginners because it's very simple and it's very easy to get familiar with. They charge no fees, and they also offer pretty good passive income on the money that you have sitting idle, just not as good as Fidelity. And another thing that I thought was cool is that if you open an IRA account with Robinhood, they'll match a certain percentage of your IRA contributions, Where I don't like Robinhood is it's become more focused towards traders and more riskier investors. They give you access to a lot of assets that are riskier than just regular stocks and ETFs, and I don't want you to have exposure to that to be enticed to invest in some of these riskier assets. It's kind of like gambling. When you see other people making money from it, you start thinking, well, maybe I should try it. But I want you to stay away from that, and I want you to just focus on the foundation. But again, Robinhood is not terrible. It's just not my favorite. So those are my 5 brokerage picks for new investors and experienced investors alike. Next, I want to talk about index funds and ETFs. For those who may not feel comfortable picking individual stocks just yet, ETFs and index funds are much better suited for new investors because they give you exposure to multiple companies at once, and they also simplify the stock selection process. ETFs and index funds trade like stocks, but they're much more diversified. Index funds are also managed by top asset managers like BlackRock, Vanguard, and State Street. So when an investment isn't performing well, they automatically adjust the allocation to focus more on stocks that are doing well. So I've created a list of 5 ETFs and index funds that I think would be great for any portfolio. Starting off, I have VOO. VOO is an S&P 500 index fund, which means that it includes the 500 largest companies in the U.S. VOO is managed by Vanguard, which is the second largest asset manager in the world, and it's very balanced. Like I said, it pretty much completely mirrors the S&P 500. The top 3 holdings of VOO are Apple, which accounts for 7%, Microsoft, which is 6%, and Nvidia, which is also 6%. VOO was my favorite ETF. Number 2 is QQQ. QQQ is a NASDAQ index fund, which is more tech heavy, but has some diversification into safer stocks like Costco and Netflix. So it gives you exposure, more exposure to tech stocks, but still has some other safety stocks mixed in there as well. The top 3 holdings of QQQ are also Apple, Microsoft, and Nvidia. However, QQQ has 9% in Apple, 8% in Microsoft, and 7% in Nvidia. So it's more weighted to the tech stocks. If I had to give you 2 index funds that should be in any portfolio, it would be those 2. VOO and QQQ give you exposure to all the best companies in the world. You can't go wrong with those 2. Number 3, I have VTI. VTI is also managed by Vanguard, but VTI is the total stock market index. So it includes and gives you exposure to every single company in the stock market. It's a very balanced fund. So if you have a lot of exposure to tech stocks or another sector, VTI gives you a great balance and great diversification. The top 3 holdings are still the same. However, it's less allocated to these 3. Apple accounts for 6% of the fund. Microsoft accounts for 5%, and Nvidia accounts for 5%. VTI is great if you're looking to add more diversification to your portfolio. Number 4 is SMH, which is also one of my favorites. SMH is a semiconductor ETF, which is heavily focused on the semiconductor industry. 2 of my stock picks that I gave last week were semiconductor companies. If you don't feel comfortable investing in just those companies specifically, SMH is a great alternative because it has a lot of exposure to those companies and you get exposure to all of them except just one. The top 3 holders in SMH are Nvidia, which accounts for 20%, Taiwan Semiconductor, which accounts for 11%, and Broadcom, which accounts for 9%. So, like I said, AI is the future. The revolution is not going nowhere. If you want exposure to semiconductor stocks, SMH is a great and safe way to get invested in those stocks with less volatility. And finally, I have XOK. XOK is also heavily weighted towards technology, just like QQQ. However, it has a much more concentrated focus on the big 3. So the top 3 holdings of XOK are still Apple, Microsoft, and Nvidia. However, 15% is allocated to Apple, 14% is allocated to Microsoft, and 12% is allocated to Nvidia. So if you want a more concentrated focus on the largest stocks in the world, XOK is a great alternative to QQQ. And these are my 5 picks for index funds that you should be interested in. That wraps up another episode. Thank you so much for tuning in. Please drop a like if you learned something new today and subscribe to the channel so you don't miss any videos. If you have any questions about anything I discussed today or just general questions about the stock market, please drop them down in the comments. And also feel free to DM me on Instagram at High Flyer Network. I hope you guys enjoy the rest of your week. Stay informed, spread some love, and I'm going to see you at the top. I'll catch y'all next time. Peace.